As we all struggle to recover from the expense-heavy holidays, there's probably no better time to talk about how to fix your empty pockets. In a previous video, we explored the fundamentals of budgeting, hopefully establishing the importance of that exercise. Now, armed with those basic principles, we embark on a deeper journey into money management in this video, hoping to arm you with invaluable insights that will empower you to fix your empty pockets once and for all. If you have been worried about just how you will achieve all of your financial resolutions for the new year, this video is definitely for you. Now, let's take a dive. To start with, you want to take a real, genuine look at your current situation. It might be saddening or even shameful to come face to face with your financial situation if it's in a dire state, but you can console yourself with the fact that this is your starting point. It doesn't matter how bad it looks right now, because the point of taking a deep look at your finances is to make the situation better. So, what exactly are you paying attention to? Of course, you need to track how much money comes in and how much goes out every month. But aside from those, you also want to pay attention to things like your net worth, your cash flow, your credit score, and your financial goals, not just for the year but for the long term, and how far you've come with them. Don't forget to clearly spell out your complete debt details, which should include your balances, your interest rates, and expected payoff dates for each of the debts. Your retirement account information, if you have one, should also be clearly spelled out. And this should include your balances, contribution amount and percentage, asset allocation, and average returns. If you have no idea about anything that was just mentioned, don't fret. We'll be covering each of those things in future videos. So make sure to subscribe to the channel and hit the notification bell so you don't miss those videos when they drop. Now, back to this one. Taking a deep look at your financial situation might look different if you have joint finances with a significant other. In fact, if not handled carefully, it could cause some flare-ups in the relationship. So first of all, you want to make sure that you both are on the same page as far as fixing or improving your finances is concerned. Discuss your financial goals and make sure that you're both being honest with each other as far as income, expenses, and debts are concerned. If the deal is for you both to pool all of your money together, then you have to disclose all of your income sources and be able to track every single expenditure. Also, no debt should come as a surprise to either of you. These discussions can be difficult to have though, so you can make things a bit easier by making a date out of it. Make sure that you're both comfortable and likely to not be in over your head. Also, be prepared to be shocked and try not to be judgmental. Allow the other person to speak and only interrupt if you're trying to ask for clarification. Depending on what your relationship with your finances is like, this might be your first time having this kind of discussion with your significant other. However, you want to make sure that it isn't your last. Have these discussions as often as possible, because the more often you do, the easier it gets. If you guys get into arguments that you can't squash between yourselves though, you might need to seek professional help from a financial advisor, a counselor, or both. After you've taken a deep look at your financial situation, it's time to assess your assets. Your assets are basically everything you own that is either cash or can be sold for cash. So your house, vehicles, retirement savings, other savings, investments, businesses, and high-value personal belongings like jewelry, artwork, collectibles, and even certain furniture are your assets. Of course, if you live in a rented apartment, neither that apartment nor the appliances and furniture that came with you are your asset. They're someone else's. The point of taking stock of your assets is not just to figure out what you own though. It's to figure out how much you're worth. So after penciling down all of your assets, right beside each one you want to pen down their value. Now, bear in mind that the value of your asset is not how much you bought it for, it's how much it's now worth, especially after accounting for depreciation or appreciation. To get the current value of your house, you might need to speak with a local realtor. For your vehicles, Kelley Blue Book or Auto Trader would be a good place to get an estimate. Just make sure that you know your mileage. For your retirement savings, you would need to check your 401k account and any IRAs that you might have. For your high-value personal belongings, websites like Invaluable.com, Craigslist.com, and OfferUp.com might give you an idea of how much each item is worth. Looking up the value of your other savings and investments is pretty straightforward. With the value of your assets properly documented, it's time to move on to your liabilities. Your liabilities are basically everything that you owe someone for. So these would include your mortgage, your credit card balances, things that you own but are still paying for, money that you borrowed from a friend or family member, or a bank loan. There are largely two kinds of debts. One is secured debt, which is basically debt that is tied to an asset, like taking out a loan to buy a car or a house. You can sell off the asset to pay off the loan. The other kind is the unsecured loan, which is debt like personal loans and credit card balances that are not backed to any asset. When you're documenting your debts, you want to include information like who the creditor is, is, how much you currently owe, what the interest rate is, how much you need to pay monthly, and when you're supposed to have paid off your debt. Now, as a quick aside, while it's almost impossible to function without debts as an adult, you want to make sure to avoid toxic debt. We're talking about loans that have super high interest rates, like payday cards and high-interest credit card debts. You never finish paying those loans, and the amount you ought to pay could even increase the more you pay. So do your due diligence before taking out a loan or getting a credit card. Armed with all that information, it's time to figure out your net worth. And the way to do this is by answering this question. If you sold everything you owned and paid off all your debt, how much money would you still have left? So the formula for net worth is assets minus liabilities. This is why you took the time to comb through your assets and liabilities. If you've done the math and your net worth is in the negative, there's no need to panic, especially if you're under 40. Now that you know the situation of your finances, you can work towards improving it. And some smart ways to do this include investing in growth and income stocks, investing in rental real estate, paying off debt, increasing your savings, and building a business. However, you still will not see any positive changes in your financial situation if you continue exhibiting bad money habits. So stop buying items that you don't need just because they're on sale. Stop buying more than what you need with your credit card because you want to earn points. Adding more items to your cart so that you don't pay for delivery is really not wise. Insurance could actually save you money in the long run. Refusing to take risks by saving instead of investing could be losing you money. And never forget that what you spend on your credit card you have to pay back. So try not to exceed 30% of your credit limit. As you work on improving your net worth, one of the first things you want to do is track your cash flow. This is not just about where your money comes from and goes to, but also how often it comes and goes. Ideally, your bills and income should sync. That is, your income should come in about the same time that your bills are due. This way, you can easily automate your bill payments and you won't accidentally spend your money on something else. However, there are a few things that are ideal in this world. If your cash flow is not one of those, there are a number of ways you can work around it. One way is to speak with your employer to shift your paycheck schedule or give customers incentives to pay you quickly. Where this is not possible, you could try rescheduling your bill payments. In fact, this one might be easier. However, you have to be careful not to become a victim of the deposit hold. The deposit hold happens when your money is delayed in reaching your account. And it could be because the account is new, the deposit is more than $5,000, or you have overdrawn for that month. Whatever the case, it's important that you properly time your reschedule so that there'll be money in your account when your bill is due. And if that also fails, you would just have to build a bridge savings account. This way, when you get your income, you can send your expenses to that savings account and then automate your bill payments to that savings account. With your cash flow properly spelled out, you're now better equipped to tally your income and track your spending, both of which are important if you ever hope to achieve any of your financial goals, or to just survive as an adult. In tallying your income, you probably already know to do that with your net profit, not your gross. This is easy if you have a regular job because all the taxes and 401ks are automatically removed. But as a business person or freelancer, things might be a bit trickier. The general rule of thumb is to less your tax and running cost from your gross. Another problem that you might run into as a business person or freelancer is saying for sure what your income is. Because you earn different things from month to month, it might be difficult to budget. So what you want to do is to choose the least amount of money that you make in your business and budget with that. You then need to make plans for any extra money that you might get. You can do whatever you want with this extra money, but try making smart decisions like clearing a debt or adding it to your retirement fund. For your investments, there are some things that you need to know. First, interest gets taxed at your regular income tax rate, unless the source is a municipal or state bond. And second, stock dividends and capital gains are taxed based on how long you've had them. As you tally your income, don't forget to include sources that are not exactly frequent. You might need to keep a different bank account for them though, so that you don't confuse yourself. However, for one-time inflows, say like a prize, you don't need to record them or make provision for them. Just add them to one of your savings pots or treat yourself. Finally, about tracking your spending. The best way to do this is to do it in real time. Write down every single thing that you spend your money on. Alternatively, if you pay for everything with a card, you could just check your paper trail for the month and only write down expenses that you pay for with cash. Knowing this, it might be best to have just one card for spending. It's easier to track your spending this way. Also, because some expenses do not occur every month, you might need to track your expenses over a couple of months. Meanwhile, build your budget based on the data that you got in the first month and just adjust your budget as you get more data. Don't forget to account for some seemingly unexpected expenses. You might need to repair something or replace something. Having an emergency fund could help ensure that you're never left scrambling. At the end of the day, budgeting is never a one-and-done thing. You always have to revisit and tweak, especially considering that circumstances change. Your income could increase or, unfortunately, reduce. And the same thing could happen to your expenses. So be prepared to adjust your budget to reflect your current circumstances. Now, you might be thinking about how time-consuming the whole budgeting process is, but consider all the benefits that you can reap from the process. You're always conscious of your spending choices. You learn to make better financial decisions. You are rarely ever caught unaware, and you have a clear path towards wealth creation. You can see exactly what needs to be done to reach your financial goal. It just makes sense to budget. If you found this video helpful, you would find the next video, Why You're Making It Hard for Yourself, even more helpful. So go ahead and click that subscribe button and the notification bell, and we'll see you in the next video.